All right, let's get right into it. When it comes to investing, we're always told to look ahead, right? To focus on the future. But what if the real secret weapon, the biggest edge you can possibly have, actually comes from looking back? Today, we're going to dig into why understanding market history isn't just some boring academic exercise. Nope, it's a powerful, powerful tool. A tool used by the absolute legends, from Benjamin Graham all the way to Warren Buffett.
The late, great Peter Bernstein just completely nailed the heart of the problem with this quote. You see, at the very peak of a bubble, or in the absolute depths of a crash, the market isn't really driven by spreadsheets and data. It's driven by pure, raw, collective emotion. It's that moment when everybody is absolutely certain they know what's coming next, and, well, that's usually the exact moment they're about to be proven spectacularly wrong.
And that flawed certainty Bernstein talks about, it's really fueled by one central problem. A kind of collective forgetting, what you might call market amnesia. It's this weird tendency for all of us, investors and even the so-called experts, to believe that this time is different, totally ignoring all the clear lessons from the past.
Benjamin Graham himself said it best. He borrowed a line about the French monarchy that just fits Wall Street perfectly. It's this endless cycle, greed, fear, hope, and then forgetting all about it. It just guarantees that the same mistakes are going to be made over and over and over again. It's pretty much proof that in the markets, history is always rhyming, even if it doesn't repeat word for word.
And listen, it's not just the average person. Even the people at the very top aren't immune to this. I mean, when former Fed Chair Alan Greenspan famously claimed he'd never seen a bubble, a lot of people were just scratching their heads. The oil bubble, the gold bubble, the bubble in Japan. I mean, the list just goes on. It's a perfect, almost unbelievable example of expert amnesia in action.
So how in the world do you fight this kind of amnesia? Well, you do it by looking at the most dramatic case study you can possibly find. To really get why history matters, we've got to go back, way back, to the ultimate market stress test, the Great Depression. Because this is where Benjamin Graham discovered one of the most incredible opportunities in the history of finance. First, just try to feel the sheer devastation here. The crash wasn't just a bad day or a bad week. It was a brutal, soul-crushing decline that just went on for years. From that peak in 1929, the market just spiraled down and down and down, wiping out fortunes and shaking the very core of the American economy.
This one number really says it all. The Dow Jones lost nearly 90% of its value. Can you even imagine that? The complete certainty of the Roaring '20s boom had totally flipped on its head into the absolute certainty of just unending ruin. And it was in this environment, this atmosphere of total despair, that Graham started digging into the numbers.
Now, to really get what Graham found, you need to know this term, net quick assets. Okay, so forget about the factories or the brand or the inventory. This is just the stuff that's easy to sell, like cash in the bank, stocks, what people owe the company, minus everything the company owes. It's a super, super conservative way of figuring out what a company's worth if you just shut it down.
And this was his absolutely stunning conclusion. In 1932, Graham figured out that the market's pessimism was so extreme, so total, that it was valuing companies for less than they would be worth if they just closed up shop, sold off their liquid assets, and paid back all their debts. The market was basically saying these businesses had negative value as an ongoing operation. And hey, this wasn't just some abstract theory he had. Look at the raw data. This is insane. Okay, take White Motors. The market was selling the entire company for just under $5 million. But get this, you look at their books and they were sitting on over $8.5 million in cash alone. And their net quick assets, over $22 million. I mean, think about that. You could have literally bought the entire company and paid yourself back more than 4 times over just by liquidating the easy stuff. It was a mind-boggling bargain created by pure, absolute terror. So, if the market has such a terrible memory, what's the antidote? Well, it's about developing what you could call the historian's advantage. It's about gaining a perspective that lets you see the patterns that everyone else, caught up in the emotion of the moment, completely misses. The legendary investor Jim Rogers puts it so bluntly. When young people ask him what they should study to be successful, he doesn't say finance or marketing. He says history. Why? Because these cycles repeat. Human nature is a constant. And the stock market didn't just pop into existence the day you opened your brokerage account.
And he is definitely not alone. The bond king Bill Gross, the global investing pioneer John Templeton, and of course Warren Buffett.
I mean, Buffett famously spent countless hours just reading old newspapers from the 1930s, not just the business section, but the ads, everything, to get a real feel for that time. For these titans of investing, history isn't just a hobby, it's a core professional tool.
But studying history does more than just show you old patterns. It actually changes your whole mindset. It forces you to stop looking at the blinking ticker tape and to start thinking like a business owner, which was really Graham's ultimate lesson from the depths of the Depression.
And this really gets to the heart of it all. In the craziness of the market, people forget what a stock actually is. They forget that it's a tiny piece of a real business. They get obsessed with the price, the quote on the screen, and they completely lose sight of the real value of the company they partly own.
So this was Graham's call to action, to stop being a passive owner of a quotation and to actually become ownership conscious. To remember that you have rights and you have a stake in a real business. And this whole philosophy, well, it's the direct line from Graham's way of thinking to that of his most famous student, Warren Buffett.
So how do you keep that ownership mindset when the entire world is screaming at you to panic and sell? Well, Buffett took Graham's core idea and turned it into this powerful mental model that he calls the Inner Scorecard. It's all about how you measure success and ultimately how you measure yourself.
So here's the difference. The outer scorecard, that's living your life for the world's applause. Your self-worth is totally tied up in what other people think, in fame, in the daily stock price. It makes you incredibly vulnerable to crowd psychology. But the inner scorecard, that's totally different. That means you are judged by your own standards. You focus on your principles, on what you truly believe is right, and that makes you independent and really, really resilient.
And this is exactly why it's so powerful. An inner scorecard gives you the freedom to make unpopular decisions, like when Buffett completely sat out the dot-com bubble. It allows you to be truly rational because you're judging an investment on its own merits, not on its popularity. And it makes you incredibly resilient, so you can just shrug off criticism, because you're not playing their game, you're playing your own.
At the end of the day, having an inner scorecard and being ownership conscious really comes down to perspective. It's about being able to tune out all the noise, the constant daily chatter of a market that's obsessed with itself, and instead listening to the deeper, more timeless lessons of history. So, I guess the real question is, which story are you choosing to listen to?